Obviously, the cut was not a surprise. They don't tend to buck market expectations, especially when they are particularly dominant in one direction or another. We did expect what could be defined as a hawkish cut, where they certainly didn't lay out any promises for the glide path going forward, and that's what happened. And just before I came on, you were talking about increasing dissents on the Fed. I agree. I think that that is a good thing. I think it also helps to temper some of the concerns about independence of the Fed, and maybe something that either implicitly or explicitly Powell is supporting, that we can hear from lots of voices. And I think it's a reminder that the C in FOMC is committee, not chair. So I think from the standpoint of that amount of uncertainty with regard to Fed independence, I think dissents and a wider array of views is a positive.
Yeah, and speaking of new voices, Liz Ann, we're going to get a new Fed chair. We know this in May. So how are you thinking about the interest rate landscape in 2026? Are we going to get more, do you think, than that one cut that Powell was talking about this week?
Tell me what the data is going to be, and I could give you an easier way to. I mean, when you're in a data-dependent Fed, and then you had the effects of the government shutdown, which means we haven't had any official labor market data since the September release. We don't have GDP data. We don't have national income and product accounts, corporate profit margins data. So I think as we start to get the data, I do think that the Fed, as it relates to their data dependency, they don't have a blind eye to inflation, clearly, but I think the needle mover from a reaction function will continue to be on the labor market. So you could have a scenario where they cut more than the one or two that is priced into expectations. I'm not sure that that's universally a positive thing if it comes because of serious deterioration in the labor market, but I think the labor market is what's driving the bus right now.
Liz Ann, from an earnings perspective, we had some really good earnings over the past several quarters here. The third quarter in particular, I think, was really surprisingly on the positive side of vis-a-vis street expectations. Is the current earnings environment enough to support this market here, do you think?
Well, actually, the trajectory of earnings among different cohorts, I think, is one of the reasons why we have started to see this broadening out. Over the last 6 months, only 17% of the S&P's constituents have outperformed the index itself. Over the past month, that's up to 54%. Yeah. And I think it's the differential in earnings growth profile. So if you look at any typical AI mega cap cohort, Mag 7, or maybe a slightly broader AI basket, or even if you just hone in on the tech sector, over the last 6 to 7 quarters, you've seen a pretty meaningful deceleration in the pace of earnings growth. Still strong earnings growth, still better than the rest of the market, called the other 493. But we're starting to see convergence there because you have the rest of the market seeing an accelerating pace of earnings growth. And I'm always fond of saying better or worse matters more than good or bad. And it's that better in the case of the rest of the market, a little bit worse, though in an absolute sense still strong. That has been a support for this broadening out. And I think that has legs in 2026.
So, Liz Ann, we talk a lot about valuations and valuations being pretty frothy, but where is there the bargain buy for investors in equities in the new year?
I don't know that there's any one monolithic place where you can find a bargain buy. I think that there is value to be found. And that has a lot to do with what's been happening under the surface. There's so much focus on just what the indexers are doing, the cap-weighted indexes. S&P is up 38% from the early April closing low on April 8th. But the average member within the S&P is had a maximum drawdown of 19% just since April 8th. The Nasdaq's up 55% just since April 8th, but the average member within the Nasdaq has had a 40% maximum drawdown. So with all this churn and rotation under the surface, that's where value is being found. I think this is an environment, though, where to bring back an old school acronym, where you want to be mindful of value, but you don't want to sacrifice growth. So it's very GARPy in terms of the factors we think you want to focus on.
Liz Ann, from a factor perspective, is there anything that screens particularly well for you these days?
Growth-oriented factors are doing very well, and I think that is particularly important when you go down the cap spectrum. So if you look at the Russell 2000 and you break it out between its profitable and non-profitable components, the non-profitable components are outperforming the profitable components by more than double on a year-to-date basis, and it's even more extreme if you just go back to the April 8th closing low. I would absolutely fade that lower quality, unprofitable cohort within the Russell 2000 and lean into the profitability piece where you have better fundamentals, and you have had the relative underperformance to the unprofitable. So again, you want to look at value components, price to book, price to sales. You want strong balance sheet, high interest coverage, but you want those positive earnings trends, forward revisions, earnings expectations being exceeded during earnings season. So it's a combination of both value and growth factors.